Hello, very good morning to all and happy Wednesday or happy Fat Day. Very good morning. Today it will be the Wednesday, the 18th of December 2024. Very good morning to all. So before we start our daily dose of market insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook, let's have a quick recap what has taken shape yesterday in terms of key economic data release, news flow, and as well as the intraday performance of the respective key broad-based cross asset classes. So we know that today is a rather important key event risk day, which is US FOMC meeting, and this meeting will take shape in early Singapore time tomorrow on the Thursday. So later I'll touch more about that, what market is expecting and what we should be looking out for. All right, so let's start what has taken shape yesterday in terms of news flow first. All right, so in terms of news flow over here is that we do have two things I'll share with you all. Will be China. So there was actually a report out by Reuters. So over here is that there was some Reuters, so Reuters reported according to their respective sources stating that China, despite this ongoing economic weakness in their internal economy that is driving this deflationary risk spiral. I should not explain more about that, about the drivers of this deflationary risk spiral and the impact of the longer term of the China stock market, because that have been covered in my series of daily dose over the last few months. But what's interesting over here is that there was actually a very strong, we call it a policy that the China top policymakers still plan around 5% growth. Right, 5% growth. So in order to reach this 5% growth over here, they need to actually have a higher budget deficit. That means they got to spend more to drive growth. And the spending either is through infrastructure investment or directly to consumption, consumer stimulus. But the impact of all such rhetoric, that means, yes, we can see very bold statement out from sources here and there stating that China policymakers will to actually defeat this ongoing deflationary spiral in China. The marginal positive impact towards their respective stock market is getting lesser and lesser and lesser. That means, i.e., the stock market participants that is trading with the China A shares and the Hong Kong shares, that means, i.e., the Hang Seng indices, are losing patience in such grandstanding wording or phrases. Right now, market participant wants to see the real action. That means, i.e., are you really committed to actually spend X amount of monies and where this X amount of monies is heading towards to boost China economic growth? Until that happens, we are still going to see this rather whipsaw price action on the Hang Seng stock indices. Right. So another news flow is more pertaining to the medium term and long term, medium term performance. That means the multi-week to multi-month performance of the US stock indices, not the intraday. Because intraday is more dependent on flows. Flows, that means positioning and technicals. All right. So this BOFA. So this BOFA survey is rather important because it tells us the market sentiment on real fund manager cash allocation. That means these guys are deep pockets, but the allocation are more for a longer term perspective. It means medium term to longer term perspective. So based on their latest survey from the month of December, they actually found that they actually have flashed out this sell signal. That means based on BOFA internal, we call it a quantitative model. There's a sell signal that being flashed out in the US stock market after fund managers cash allocation holdings tumbled. So what it means by this over here is that the cash allocation of this fund manager actually tumbled to 3.9%. So if you look at my screen over here, right, let me expand it so that you guys could actually see. Right. Okay, so what it means that this net percentage of fund managers overweight cash. That means over here, cash holding is very high, and right now the overweight cash holding has tumbled to negative territory, and in fact is at a all-time low. That means what it means that the fund manager has really deployed most of their cash in the stock market. That means think about it as dry powder. So in order for stock market to go up, we need liquidity, right? Liquidity from fund managers cash holding. But if this liquidity starts to dry off itself, all right, because it's already more or less full, majority allocated to equities, the next driver for equities to push up higher will be tougher. So that would only come up from central banks more liquidity pumping into the financial system. Then this we have see another leg of a movement going up. So but however, the Fed may be reluctant to actually open its floodgates much further. Okay, something to take note of later when I share with you on this FOMC market preview that we may take shape, that would potentially we got to bear in mind of. All right, so this is the one of the we call it the two of the news flow that I share with you all. And yesterday key economic data more centered on the UK, which is the UK employment rate or the labor market. So the UK labor market has been robust. So in terms of employment change, it managed to beat expectation. Market is expecting negative 12K job added, but it actually recorded a positive 173K job added, but still below last month figure of 253 job added. All right, 253 job added. Unemployment rate has been stable at the 4.3%. So you look at the employment change data, the trend of it. Yeah, even though the monthly October figure beat expectation, but in the last 3 months, the growth has been trending downwards. Okay, notice the growth has been trending downwards. So if you switch it to percent change, okay, it's actually declining in the last 2 months. So net overall, yes, on an absolute basis, it beat expectation, but on a trend basis, the labor market, UK labor market doesn't seems to be on a real solid footing. All right. So yes, on the intraday basis, it causes the sterling pound to rally. Like I mentioned earlier on, why? Because the technicals are supporting it as well. For those who followed my daily dose since Monday, we have been bullish intraday on the sterling dollar. So the sterling dollar yesterday push up, almost hit our resistance. So what are the next key level and the trend bias to watch for sterling dollar for today as we head into the FOMC meeting? I will cover the latest technical outlook, intraday outlook on the sterling dollar when I touch on the intraday outlook on the FX segment thereafter. So bear in mind first, because I need to cover the other segment. All right, and another economic data will be more pertaining to the US economy. So on the US economy, market continues, the retail sales continues to be robust. So retail sales year on year came in at 3.8%, above 2.9% that was printed in the month of October. So if you look at the retail sales trend in the US, so that actually also represents services activity. Why is it important for this trend to continues to push up? Because it still represents a robust US economy, as 3/4 of the US economic growth, close to it, is driven by services activities, where retail sales is part of it. All right, so if you look at the retail sales figure, it's been trending upwards very strongly since August this year. And if you look at the 3-year trend, very clearly it's actually doing a what I call a bullish reversal formation since hitting the low in January at the start of this year at 0.3% year on year. All right, very clearly there's a kind of a breakout, a bullish breakout in the previous peak of March and July. So what does it mean for the Fed? So that means, i.e., the Fed will be less reluctant to be much more dovish next year, given the fact that US key drivers of economic growth continues to flash out robust growth. Services PMI, yes, they are covered rather robust as well, continue to expand at a robust pace. Now we have retail sales that is breaking out its previous downtrend, all right, that has taken shape since 3 years ago, hitting on a rather healthy blip on the upside. So this represents that the US economy is rather robust. So in the first half of the year, next year, the Fed will be less reluctant to even engineer any interest rate cut going forward, right, after today's potential cut. All right. So now These are the key economic news flow and data that I share with you and their potential impact on the various economic forces that may take shape from a longer term perspective, and as well as the market potential market impact. So now let me touch on the intraday movement of the broad-based cross asset classes, starting with the US stock indices. So all four major US stock indices closed in the red yesterday, despite the recent high flying Nasdaq 100 as well. But this is pretty much key, pretty much as expected. Still recall that yesterday in my intraday technical outlook, I expect the Nasdaq 100 to shape that minor pullback, and that minor pullback actually take shape yesterday, hitting at our support level and just above the pivotal support before it actually rallied in the last hour of yesterday's US session. So later I'll touch on the 1 hour chart of the Nasdaq 100 when I cover the intraday technical outlook. So movement has been more or less in line, but what's surprising over here is that the Dow Jones continues to underperform yesterday, followed by the Russell 2000. Dow Jones yesterday down negative 0.6%, the Russell down negative 1%. And in fact, the Dow Jones Industrial Average has been closing down for 9 consecutive sessions, that means 9 consecutive days. And this is the worst performance since 1978. And one of the reasons why Dow Jones actually underperformed is because it's price weighted, it's not market cap weighted. And based on this price weighted, it has a very high weightage on this particular healthcare stocks called United Healthcare that continues to plummet after a rather negative firm specific event that took shape last 2 weeks. All right, still recall there was an unfortunate event where its senior management got assassinated, and due to its what I call alleged malpractices, I would say. All right, that's all I can talk about. Some allegation, but it has a significant bearing on the Nasdaq 100 in the last 2 weeks of performance. All right, so that continues to plummet. Yesterday, the United Healthcare, which is the top component stock in the Dow Jones Industrial Average. Okay, so now with that, the FX market. Let's look at the FX market. So the FX market, what I could see over here is that continues to be what I call sideways. All right, it trended sideways. So what you could see interestingly that the dollar strength starts to dissipate in the yen over here, which is also came in via our expectation as well. Why? Because very likely tomorrow, after the US Federal Reserve announcement in today's in what I call around Asia session tomorrow at 11 a.m. This is where the BOJ will release their latest monetary policy outlook. So this monetary policy outlook, very likely we may start to see a bit of hawkish tilt in the BOJ statement. Later I'll talk more about that, okay, when I covered the things to look out for during the economic calendar. So it's more of like a yes, the trend. Okay, so this should be as of now, 18th of December. So the dollar trend on the dollar yen starts to dissipate over here, and the rest of the other dollar major currency starts to trade sideways as we head into the we call it FOMC meeting today. All right, yeah, this should be 18th of December. Okay, so now let's talk about a bit of the FOMC meeting preview. All right, so if you look at the FOMC meeting preview over here, by looking at the CME Fed Watch tool, so those who follow my daily dose of market insights, this tool should be not a big surprise. So this tool is freely available, but the whatever data here is not live, it's about delayed about 2-3 hours. What CME does over here is that they have this tool based on a calculation of the Fed funds futures market. So futures market allow us to gauge market sentiment because futures contract is always 30-day down ahead, right? So from this pricing of the Fed funds futures contract, we could gauge what is market expecting that the Fed may do going forward today and in future FOMC meeting. So in the Fed CME Fed Funds Watch tool, pardon me about tongue twisting, for today is almost near certainty that the Fed will cut. So that is already been priced into the market. Okay, so the only big surprise over here is that the Fed don't cut and maintain its stance at 4.5% to 4.75%. Then that could see a rather volatile market situation for today. That means, i.e., the US stock market may sell off and the dollar strength may shoot up tremendously and gold may tumble significantly as well if the Fed doesn't cut today, because it's almost certainty that 96% chance that the Fed will cut by 25 basis point. Why 25 basis point? Very simple. You get the current rate 4.5% minus the rate that market is expecting it will be at the end of the FOMC meeting today, 4.25%, 4.5%. So that's an implied rate of a 25% cut. All right. So now going forward, market now is actually trying to play out what will the Fed do going forward. All right. So if you look at the aggregated probability, so this is where the CME Fed Watch 2 price down the futures pricing as of now, maybe 2-3 hours delayed from now. There's a time lag. What the market expect the Fed will be 12 months down the road. All right, so let me expand my screen so that you guys could see. All right, so over here, the market is expecting after today's high chance of a 96% cut to bring it down to 4.25% to 4.5% on the Fed funds rate. In July, they will, not in July, not in January, pardon me, in January next year, they will stamp at very high chance of 86%. Only a small chance of 13% that they will cut. All right, then thereafter, it will start to engineer a cut in either one of these months, March, May, June, July. Okay, either one of these months, because it rather have a high chance of 66%. The highest will be in May at 91% chance. All right, so in May, with the highest percent chance, 91% or 92%, that market is expecting another 25 basis point cut, which is at 4% to 4.25%. And thereafter, we start to see a high chance of 81% and 92%. Either they will do it in October next year or December next year to bring it down to 3.75% to 4%. All right, so that is a very important implication on the market pricing right now. So market is now looking at a less dovish Fed going forward in 2025. So after the Fed funds rate, if they bring it down to 4.25% to 4.5%, market is only expecting 2 more cuts next year of 25 basis point each. That means, i.e., a less dovish Fed. Why do I say a less dovish Fed? Because if you look at the last dot plot of the US Federal Reserve meeting, okay, so you can just go to this website. All right, so over here they give us the dates of the meeting, and as well as the statement, the press conference, and other materials. So every 3 months the Fed will release a dot plot. So the dot plot one will be associated with a star meeting, associated with a summary of economic projection. So in market terms, we call that dot plot. Okay, I think it's my screen is, hopefully you guys could actually see the screen. Okay, it seems to me that the screen is not reflecting what I am sharing. Okay, give me a minute. So let me make sure that you guys could see my screen. Okay, good. Yeah, so this, hopefully the screen is all good. All right, it should be fine. So this website here is the US Federal Reserve meeting website. If you just Google US Federal Reserve monetary policy calendar, then you're able to see the various meeting in as well as going forward. Okay, so what I'm going to share with you all is every meeting they will release, they will show you the press conference, the statement, and as well as additional materials. So some meeting there will be have a star, okay, asterisk. So what this star mean? Because this meeting, that means today's meeting as well, in early Asia session, early Asia morning, tomorrow at around 3 a.m., they will come up with the dot plot, which is the summary of economic projection. Why this dot plot is important? Because this dot plot indicates Federal Reserve officials' median projection where the Fed funds rate will be next year and the year after. Okay, so the last dot plot was released in September, so that was way before Donald Trump winning the White House. So at that dot plot, if you were to look at the dot plot materials over here, projection materials, okay, so you go all the way down, you're able to see this. They also project inflation as well. Then they have this Fed funds rate where they expect to be. So based on June projection, previously they are looking at 4.1%. And in September, they turned ultra dovish. They expect 2025 to be 3.4%. So if you look at 3.4%, you deduct off what the market is expecting to be after today's FOMC meeting, which is at 4.5% to 4.5%. In order to reach 3.4% over here, the Fed got to cut around 4 cuts in next year to reach 3.4%. That was their desired path based on the September dot plot. So market now doesn't believe that the Fed will maintain this 3.4% in 2025 because of why? The inflationary pressure that could resurface in the US economy due to Trumponomics 2.0, or we call it the American First policy. All right, and that has also been depicted by the rising US break-even rates, right? So this US break-even rates over here is moving in line with the 10-year US Treasury yield as well. So this break-even rates has been rising steadily since the start of the current Fed interest rate cut cycle in September. Right, so this break-even rate, the dark blue line and the light blue line, the 5-year, which is at 2.36%, and the 10-year US break-even rate is at 2.31%. So that indicates what I call US inflation potentially from 5-year down the road and 10-year down the road. So that has really lifted a fair bit from the US Federal Reserve long-term 2% growth target. All right, so what does it mean? So potentially, market participants will be hearing very closely on the press conference and looking at the latest dot plot projection that will release in 2 days to see where the Fed forecast or their desired Fed funds rate will be in 2025 and 2026. So it represents only one interest rate cut for next year. So that will be giving us a hint that the Fed may even stand pat next year and even does not engineer any interest rate cut at all potentially. And also during Fed Chair Powell press conference, how he will be quizzed on what the Fed likelihood or thinking will be in terms of next year up and coming fiscal policy from the Trump administration. So if he starts to say some things that he will be paying very close attention to Trump's fiscal policy and as well as trade tariffs that could impact the US economy, that will also indicate a potentially less dovish Fed going forward in 2025. And that could also hint that the dollar strength may continue to remain firm. Why? Because the longer term US 10-year Treasury yield is now testing its key major technical bullish flag configuration level, which is at around the 4.4% and the 4.49%. A breakup more confidently above 4.49% potentially sees the US 10-year Treasury yield inching higher towards 5% and thereafter 5.2% in the months ahead. So if the US Treasury yield keep going up higher, especially the 10-year, that actually represents that market participants right now is also looking at a higher inflationary environment in 2025, and also that could cause the Fed to be less dovish. And what does it mean? Potentially the dollar will be firmer. And for the US stock indices will be rather mixed because the US stock indices, there's two conflicting factors at play right now. Yes, higher longer term 10-year US Treasury yield indicating a longer term higher interest rate environment. Potentially that could actually cramp down net interest margin for US equities earnings growth. But on top of that, we do have Trump generous tax cuts coming into the picture. All right, so the market, US stock market will be sandwiched between two opposite forces in the medium term. So what I could foresee that if such scenario play out, it will be a bumpy ride for the US stock indices in 2025. Okay, so this is something I want to share with you all, kind of a preview on today's FOMC day and what will be the likely outcome or the scenario to take note of and their impact, the longer term impact on the FX market and the major US stock indices. All right, so without further ado now, let us now jump straight into the shorter term intraday technical outlook that purely focus only on technicals and momentum. All right, so with that, let me expand my screen so that you guys could actually have a better view of the charts. Okay. All right, so as usual, let's start with the FX market first. So on the FX markets, let us focus our attention on the euro dollar. So the euro dollar on Monday and Tuesday, we do have a bullish bias. So the first resistance level to watch will be 1.0540, which is also very close to the 20-day moving average as well. So yesterday's during the start of the Asia session, it managed to hit that 1.0540, came back down during the US session. At the end of towards the end of US session, managed to retest the 20-day moving average then before trading back down again. So it seems to us that over here the bulls are quite reluctant to push it higher above the 20-day moving average. So with that, I will use 1.0540 as my short-term pivotal resistance level for today, flip back to a bearish bias on the euro dollar. First near-term support level to watch on the intraday will be 1.0460. Below it exposes 1.0410. All right, so we'll be flipping to a bearish bias due to the lackluster movement after around the 20-day moving average in the past two sessions. Only an hourly close and a push up above 1.0540 short-term pivotal resistance will invalidate today's intraday bearish bias to see a mean reversion rebound on the intraday basis, exposing the next near-term resistance level next at 1.0570, followed by 1.06 figure level, which is the minor swing high area of 29th of November and 6th of December that the bulls has yet to surpass above it. So that's for the euro dollar, flipping to a intraday bearish bias using 1.0540 as my short-term pivotal resistance level. Now, turning our attention with the sterling dollar. So the sterling dollar actually fared much better in the last 2 days against the euro as it managed to surpass above its 20-day moving average and hit the resistance level as desired. All right, 1.2720 yesterday. So upon hitting this resistance level, price action shaped a higher high. All right, but the RSI shaped a lower high. All right, a lower high, and it seems to be also get rejected by this descending trendline resistance as well that is in place since previously at the extreme overbought level of 29th of December. So indicating that this upside momentum yesterday that's being formed has started to be dissipated on the intraday basis, which means I turning weak. So the way it turned weak also correspond to that rosy Labor Day data, labor market data from UK on an absolute basis, but not a trend basis. So with that bearish divergence and the bearish reaction of this key parallel descending resistance that's being depicted on the hourly RSI, I have no confidence to continue to play that mean reversion rally up on the sterling dollar. So in between over here, there might be a bearish reversal taking shape. So because I don't want to get whipsaw in between 12720 and 12728, which is very clearly this is a key short-term resistance level. Previous swing high 11 December got rejected, 12 December got rejected as well before shipping that short sell off on last Friday. So with that, I don't want to put it so tight in between this level, so I'll put it at the top 1.2780 as my short-term pivotal resistance level. Flip to a intraday bearish bias for today. First near-term support level to watch will be the 20-day moving average at 1.2675. A breakdown below it, revisit last Friday minor swing low area 1.2610/1.26 figure level. Only a push out with an hourly close above 1.2780 invalidate today's intraday bearish bias to see a squeeze up towards 1.2810, 1.2840, which correspond to the 200-day moving average and the 50-day moving average as well. All right, over here. Okay, so net overall, due to this rather negative element that's been depicted out on the hourly RSI, depicting a lack of bullish momentum, we will flip to an intraday bearish bias for today using 1.2780 as my short-term pivotal resistance level. Okay, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific dollar pair, major dollar pair, starting with the dollar yen. So dollar yen yesterday actually pushed down as expected, and it broke below the minor ascending trend line support or minor ascending channel support that is in place since the low of 6th of December. So like I say, the dollar is weakening against the yen. Why? Because of BOJ monetary policy decision, which is going against the other central banks policy decision. So other central banks are, yes, they are in the mode of cutting rates, but BOJ is in the mode of normalizing rates on the upside, a slow, gentle interest rate hike. So there's actually a growing, increasing odds that BOJ may hike tomorrow. That means in tomorrow Asia session, as depicted by the yield spread between the so-called the yield spread between the 10-year US Treasury yield and the 2-year the JGB yield. So what's this? I already covered in yesterday's intermarket dynamics, but nevertheless, let me flash to you guys again in case for those who miss out yesterday's intermarket dynamics. on the FX market, where I plot the dollar yen against the yield spread of the US Treasury versus the JGB yields. Okay, let me share with you guys. Okay, so what I could see over here is that very clearly the 10-year US Treasury yield minus the 10-year JGB yield, the 2-year Treasury yield minus the 2-year JGB yield is forming a potential lower high right below a key medium-term resistance at 3.7% and 3.84%. And right now, the dollar yen also is forming a lower high as well, right above this major descending resistance line. That major descending trend, key medium-term descending trend line from, or major descending trend line from 12 July 2024 high. All right, so that could actually see a bit of downside pressure on the dollar yen, at least on a intraday basis, as we head into Bank of Japan meeting tomorrow. So back to the intraday technical of the dollar yen. So still no change. First resistance level to watch will be 153 or 154 figure level, which is the pullback of the former minor ascending channel support, now turns into a pullback resistance. And I don't put it so tight at 154 figure level just to prevent any whipsaw, because of today's there's a key risk event day, which is FOMC. Still using the 15470/155 figure level as my short-term pivotal resistance zone, maintaining the intraday bearish bias. First near-term support level to watch for today, 15270. A breakdown below 15270 exposes 15190, which also confluence with a bunch of moving averages, the 20, the 20, the 50, and the 200 day. Only an hourly push up above 155 figure level will see the continuation of the rally on the dollar yen to expose the next near-term resistance level or zones at 15585/156, followed by 15675/157 figure level, which is the minor swing high of 15th of November. So that's for the dollar yen. Now, turning our attention lastly on the FX market will be the Aussie dollar. So Aussie dollar, yesterday we have a neutrality stance because of the sideways movement. After this sideways movement, actually staged a bearish breakdown below 63.40. So this is very important. Why? Because if you look at the daily time frame chart over here, very clearly there's a daily close below the former major support of 63.60. Why this support is major? Because 63.60 in 3 instances, from the 10th of November this last year, the 19th of April this year, the 5th of August this year, after hitting 63.60, price action managed to stage a mean reversion rebound on a multi-week basis, but it unable to hold this level after the test of it since last Wednesday, and finally yesterday it staged a daily close below it. And with that, what we could see over here is that it actually also shaped a bearish breakdown from this major sideways range configuration that has been in place for close to a year, since 13th of October 2023. So with this inflection level that's been taken out, a major inflection level is taken out, and also given that it's a major bearish breakdown of a major sideways range configuration on the Aussie dollar. So what we could unfold on the Aussie dollar now is a multi-week to potentially a multi-month bearish down move impulsive sequence. All right, yes, on the intraday basis we may see a bit of bounce here and there, but from a longer term perspective, multi-week to multi-month, potentially right now it starts a bearish sequence. All right, from there. Okay, so on the intraday basis, okay, on the Aussie dollar, so what are the key levels to look out for? So first resistance will be the 63.40, 63.80 will be my key short-term pivotal resistance. Okay, I repeat, first resistance 63.40. I don't put it so tight because today is the key risk day, event day, which FOMC meeting. I'll use a slightly higher one. So very key, this is the range top that can't break out above since 13th of December on Friday. So 63.80 short-term pivotal resistance level, flip to a intraday bearish bias. Next two support level to watch for today on the intraday basis, 63 figure/62.85, followed by 62.45. All right, over here, which is the 0.236 Fibo extension, and also coming close to the low of this medium-term descending channel that I drew from the high of 30th of September. Okay, this year only an hourly push up and the close above 63.80 will invalidate today's intraday bearish bias to see a choppy up movement to retest the 20-day moving average at 64.35, which is also the upper limit of this medium-term descending channel. Only a breakout above 64.35 in the first step will kickstart a mean reversion rebound, targeting 64.70 intermediate resistance next in the first step. All right, so that's the Aussie dollar flipping to a intraday bearish bias below 63.80, and also potentially the Aussie dollar has now unleashed a major bearish breakdown below its key major support level at 63.60 as depicted on the daily chart right earlier on. So that sum up the intraday technical outlook on the major dollar FX pair. So with that, let us now focus our attention to the major stock indices, starting with the Hong Kong 33. So like I mentioned, despite very strong rhetoric out from China, this level here that plans the 5% growth for next year with higher deficit, market is no longer biting this kind of grandstanding words. They want to see more action. So a very negative price reaction for today on the Hong Kong 33 or the Hang Seng Index, right at yesterday's short-term pivotal resistance that highlighted 19,960. So still no change, using 19,960 as my short-term pivotal resistance. Maintain that intraday bearish bias. So first support level to watch out for today will be yesterday's Asia session low. All right, we set 19,600. A breakdown below 19,600 there about exposes the next near-term support level at 19,337. Only an hourly close above 19,960 will invalidate today's intraday bearish bias to potentially see a squeeze up to revisit 20,300 / 20,520 next intermediate resistance zone to watch. So that's for the Hong Kong 33, still maintaining that intraday bearish bias below 19,960 short-term pivotal resistance level. Okay, now turning our attention will be the Nikkei 225 or the Japan 225. So the Japan 225 broke down below the minor ascending channel support and also the 50-day moving average, so indicating the lack of bullish momentum, and so invalidate yesterday's bullish bias to indicate that the Japan 225 may now continue to slip down towards the lower limit of this sideways complex range that is in place since 27th of September this year. Okay, this kind of sideways complex range after the recent test of it of 12th of December at the upper limit on at 40,155 / 280, which is the upper limit of this sideways complex range. So with that, use yesterday's breakdown level of 39,480 as my short-term pivotal resistance level, flip to a intraday bearish bias on the Japan 225. Next two near-term support level to watch on an intraday basis, 38,990 followed by 38,670, which these two intermediate support level confluence with the 20-day, 50-day, and the 200-day moving average as well. However, only a push-up and hourly close above 39,480 will invalidate today's intraday bearish bias to see the push-up to retest 39,830 and maximum 40,155 / 280, which is the upper limit of that complex sideways range configuration in place since 27th of September this year. Okay, so that's for the Japan 225, flipping to a intraday bearish bias using 39,480 as my short-term pivotal resistance. Now, the German 30 also facing a bearish pressure as well, breaking below our short-term pivotal support yesterday at 20,360, as it continues to now unleash that mean reversion decline scenario within this minor ascending channel support since the low of 19th of November. So with that, I will flip to a intraday bearish bias on the German 30, respecting the negative price action that has taken shape yesterday, using 20,360 as my short-term pivotal support. Using 20,360 as my short-term pivotal resistance level, flip to a intraday bearish bias for this mean reversion decline to play out. 20,155 will be my first support level to watch. A breakdown below it exposes 20,080 / 19,960, which is also corresponding to the rising 20-day moving average, and as well as the lower limit of this ascending channel that is in place since the low of 19th of November, or the ascending channel support level. Okay, only an hourly close above 20,360 and a push up above it will invalidate today's intraday bearish bias to see a recovery to retest the current all-time high area at 20,470. A breakout above it, a breakout above 20,470 sees 20,650 next. So that's for the German 30. major US stock indices, starting with the US Wall Street 30. So like I mentioned, the US Wall Street 30, since hitting its fresh all-time high on 5th of December, it has been declining close to 9 consecutive sessions. That is the longest losing streak on the Dow Jones Industrial Average or the Wall Street on the Dow Jones Industrial Average since 1978. And what you could see right now is that yesterday we were neutral between 43.5580 and 43.820. It hit the lower neutrality limit and hit the support level at close to 43,325. So this 43,325 is in fact the congestion area of 21st of November, 18th of November, and as well as the the ascending channel support, the medium-term ascending channel support from the low of 5th of August 2024. All right, and it hit this level yesterday, and during the later session of the US session yesterday and in today's Asia session, it managed to stage a rebound. And this rebound over here also correspond to a bullish divergence that's being flashed out on the hourly RSI as price action shape a lower low. So with that, I will use 43,325 as my short-term pivotal support level, flip to a intraday bullish bias on the US Wall Street 30 upside trigger level, which is the 50-day moving average, it got to surpass to increase the odds of this recovery above 43,580, potentially sees the next intermediate resistance or near-term resistance to come in at 43,820. All right, 43,820. Only above it sees 44,040 next. However, if price action starts to have hourly close below 43,325, we will start to see the continuation of more weakness on the US Wall Street 30, exposing 43,090 and 42,890 next, which is the key minor swing low area of 19th of November. Okay, so with that, let us turn our attention to the strongest major US stock indices that is performing in the last 2 weeks, which is the Nasdaq 100. So like I say, the Nasdaq 100 staged a pullback as expected, hit our first support level before trading sideways, and the hourly RSI also managed to help right exactly at a key parallel trendline support level as well. Okay, so with that, still no change. 21,860 will still be my short-term pivotal support level. Still maintain the intraday bullish bias on the Nasdaq 100. First resistance to watch will be the current all-time high level that has been met earlier on Tuesday, 22,130, that has been met earlier on Monday, 22,130/22,160. Above it sees the next resistance zone coming in as defined by a Fibo extension cluster zone, 22,336/22,476. Only a push down with an hourly close below 21,860 will invalidate today's intraday bullish bias to kickstart a mean reversion decline scenario, exposing the next near-term support level at 21,650. Below it sees 22,400, which cross 21,000. Below it sees 21,400, pardon me, which correspond to the rising 20-day moving average as well. Okay, so that sum up today's intraday technical outlook on the major stock indices. So now turning our attention will be the commodities market over here. So the commodities market, let us start with gold XAU/USD. So for gold XAU/USD, yesterday we were bullish, attempting to play a minor bounce up towards 2674. However, price action starts to break down instead below the 20-day moving average, also breaking below our short-term pivotal support at the 2,647 level. So with that, price action now of gold XAU/USD in the near term has started to turn negative or bearish over here, potentially revisiting this kind of a minor sideways range configuration, or we call it a minor double top as well, with the double top neckline at 2,613, 2,605. So with that, first resistance level to watch will be close to the 20-day moving average at 2,658. So this will be my first resistance level, but I don't put it as my short-term pivotal resistance because of today's key risk event, just in case of any whipsaw around this 2,658. I'll put it slightly higher at 2,674, which will correspond to that former minus swing low area of 11th of December and 30th of December. Last Friday is that stage that intraday bearish breakdown upon breaking that 2,674, also correspond closely with the 50-day moving average. So using 2,674, a slightly higher level than 2,658 due to potential whipsaw from today's FOMC meeting. flip to a intraday bearish bias for gold XAU/USD to revisit the lower limit of this sideways range configuration and also potentially the minor double top configuration of this this minor double top range configuration. Neckline support at 2006.13. Okay, so two support level to watch: 2006.31 followed by 2006.13, 2006.05. Only hourly close above 2006.74 will invalidate today's intraday bearish bias to see a push up towards the top of the range again at 2006.90 and even the range resistance level at 2007.28. Okay, so that's for gold XAU/USD, flipping back to a intraday bearish bias using 2674 as my short-term pivotal resistance level. Okay, now lastly will be the West Texas crude oil. So West Texas crude oil plummeted as expected. Okay, it plummeted as expected over here. Now the RSI hit the oversold level and managed to stage a bounce, and it managed to bounce as well at the start of the US session, right exactly at the 20-day moving average, which is also our support level. So using 69.30, so as it's going to congest in this kind of sideways range configuration since the low of 18th of November. So using 69.30 as my short-term pivotal support for today, flip to a intraday bullish bias within this minor sideways range configuration. Next resistance level to watch in the near term, 70.94. That was rejected on yesterday before that intraday sell off during the US session. Above 70.94, see 71.70, which is this sideways range configuration that is in place since 18th of November. Upper limit 71.70 next. Only a push down with the hourly close below 69.30 potentially invalidate today's intraday bullish bias to allow the West Texas oil to float down towards the lower half of this sideways range configuration. Support level to watch next 67.85, followed by the sideways range configuration support of 67 figure next that has been in place since the low of 15th of November. Okay, so that's West Texas crude oil, and as well as the intraday technical outlook on all the major cross asset classes. So before we go, let's take a look at the calendar. So I mentioned today key risk event will be the FOMC meeting. So other than that, during the European session, we do have inflation rate on UK coming out at 3 p.m. Singapore time. That could also impact Bank of England decision tomorrow, and as well as the sterling dollar later on. Okay, market is expecting an uptick in inflation to 2.6% year on year from 2.3% that was printed in November. In October, and the core inflation rate as well, market is expecting a 3 basis point increase to 3.6% from 3.3% that was printed in October. And thereafter, for Eurozone, nothing important, and the oil important. Then this will be oil pertaining to oil price, the weekly EIA crude oil stockpile change for the week ending 13th of December out at 11:30 p.m. Singapore time. And this is the all important decision, 3 a.m., where the US Federal Reserve will release its monetary policy decision. I mentioned earlier in today's preview that market is really close to certainty that it will cut by 25 basis points. But what's important is the dot plot, the economic projection that is out later. Market potentially may see a less dovish Fed in 2025. That means from a Fed pivot to a normalization pivot. All right. And most importantly, also at 3:30 a.m., Fed Chair Powell press conference, where he will be pressed by reporters what's Fed's thinking ahead that could potentially impact their monetary policy decision making in 2025, in line with Trump's fiscal policy and his trade tariffs policy. Okay, then I mentioned 11 a.m. tomorrow Asia session time. While we kickstart our daily dose for tomorrow, we will have Bank of Japan interest rate decision, where potentially the Bank of Japan may turn to a much more hawkish mode, given that we start to see improving inflationary situation in Japan, and as well as with some key leading economic data like services PMI in Japan continues to remain robust. All right, so that sum up today's daily dose of market insights. So with that, I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.